One of the mistakes new investors make in the stock market is getting overly excited during market rallies. After all, it's easy to get caught up in the euphoria when the market only seems to go up and to the right. In fact, the US market has been on a bull run since the financial crisis of 2008 and only recently started to show some signs of a correction. But how should you prepare yourself when the market turns bearish? If this interests you, stick around. Before we jump into the details, do note that I am not a licensed financial advisor and none of this is financial advice. We're simply presenting our research and opinions for fun and educational purposes. We've all heard it on the news or social media, how we are in an environment of lofty valuations and the everything bubble. Year on year, the US market grew by 25%, real estate grew by 37%, and crypto markets grew by 42%. But what happens when the party stops? Traditionally, bull markets don't last for more than a decade. And as Michael Burry, who accurately timed the 2008 housing market collapse, puts it, the theatre keeps getting more crowded, but the exit door is the same as it always was. Should you invest during a bear market or recession at all? Well, statistically, most of our greatest returns are found during bear markets, if you can find great companies for cheap. Some people with high confidence in timing the market would hoard cash in preparation for the eventual downturn. However, I think that timing the market is a much harder approach than simply dollar cost averaging into your strongest convictions every month. And here's why. Timing the market comes with potentially huge opportunity costs. Because holding on to cash means you are subject to negative returns from inflation and foregoing any potential yield from dividends and premiums from selling options. We will be covering options trading in greater detail in future videos, so be sure to subscribe and don't miss it. The opportunity costs from missing out on dividends and option premiums vary widely depending on the types of portfolios. But let's take mine as an example. My portfolio is about 60% in tech and e-commerce companies, 20% in conservative, slow but steady old school businesses such as food products and precious metals mining. The remaining 20% is in a range of cryptocurrencies. Some stick for fixed interest rate and others in liquidity yield farming. I calculated the opportunity cost of sitting on the sidelines to be around 10% per year, which means that if I sit around waiting for a market crash or recession, I have to be absolutely sure that I can profit more than 10% just from that trade. Doesn't sound too difficult, right? But what if I'm wrong about the timing? What if the market crashes, but only 5 years later?
One eternity later.
The 10% yield compounded over 5 years is a 61% return, so I have to be sure that if my timing is wrong, the market will eventually crash more than 61% and that I execute the trade at the perfect time. Timing requires getting either the timing right and the magnitude of the market correction right. In my opinion, this is why you don't see traders in the top 10 billionaires list. Instead, you will find either business owners or people invested in the stock market over the long term. That said, however, you don't have to be all in on cash or all in on stocks. Depending on your investing objectives and the time horizon, you might want to keep some or lots of cash to buy aggressively when the price is right. Market corrections or crashes can be very short-lived, and nobody knows when the next black swan event is going to happen. Hence, my strategy would be to continue dollar cost averaging into great businesses, and during times when the market seems euphoric, start reserving some cash so that when the sentiment changes, I'll be prepared to buy the dip. I would stay invested in all market conditions with a readiness to change my portfolio if the investment thesis is no longer valid. So the right question isn't whether it makes sense to invest in the bear market, but rather, what should your asset allocation look like in different conditions? Now, we'd love to hear your thoughts. What's your investing strategy and how does it change during a bear market? Let us know in the comments down below. If you're interested to hear more from us, subscribe to our channel to get notified every time we release a new video. Gently tap the thumbs up button for the almighty YouTube algorithm, and if you find this helpful, share this with your friends and family. We will see you in the next video.